High-grade bonds play an important role in investors and advisors' portfolios alike, and it can be defined in three ways. I think firstly, they provide principal and income stability for investors and advisors alike. Secondly, they provide enormous diversification against your growth and risky assets in your portfolio. And then thirdly and finally, they provide strong liquidity across different markets. Firstly, when we think about principal and income stability, over time they provide that ballast for portfolios. In other words, they are the backers, being the Australian government and the states, supranationals, are compelled or obligated to make good on their principal and income over time. So you can be confident, as opposed to a corporate which would essentially go bankrupt if they have financial stress. Governments can collect money or manage their expenses to make good on their obligations. In terms of diversification against growth and risky assets, well, if you have a look at the profile of Australian shares versus Australian high-grade bonds, they are chalk and cheese in terms of the profile. Australian shares since 1990 have been down 6 times, have experienced 6 negative markets over that period. In contrast, Australian high-grade bonds have only experienced 2 down markets. So that's a good example of the difference between how these two assets behave. When you also think about the volatility that each of these assets experience, very different as well. Australian shares, quite volatile, as you would expect from a growth assets, compared to high-grade bonds where the returns are far more muted over time, even during less than appreciable sort of conditions as well. So then the third and final one is liquidity and accessibility for investors. Across all markets, Australian high-grade bonds remain incredibly liquid. And that's a function of the depth of the market and how much interest that there is in terms of the participants, including a lot of overseas investors. This is important because when you need money, whether it is personally to meet obligations or surprise sort of events, or whether you need to rebalance your portfolio, you can be confident that there is liquidity in place and that accessibility. In times that we have now in terms of markets, I think it's easy to be complacent about this sort of feature. We knew during the global financial crisis, during the dot-com era, in terms of times of market stress, that liquidity is not a commodity, particularly amongst structured and complex sort of investments. High-grade bonds, at the end of the day, are a simple, straightforward and highly liquid investment for investors and advisors alike.